Welcome to the summit. We're glad you're here. I think it's appropriate for me to go through in very top line fashion what's going on with the important initiative around the financial value of brands. The position that we've come to in terms of the team that's working very diligently on it is that regular measurement of brand value and strength advantages the practice of marketing by demonstrating the overall contribution of brands to the value of the enterprise. Part of our remit to the standard setting boards, ANSI in North America and ISO on a global basis, our remit is that we share this broadly within the marketing world to get people's feedback and commentary. And I think we've certainly delivered on that. So the logic flow that we are having that we've discussed and gotten good feedback and has been improved by the contributions of the group is that marketing exists to drive profitable growth. Growth is measured in financial terms. Long and short-term growth is driven by increases in brand strength and/or customer franchise. Long-term growth is of most value, because it extends over time, while short-term growth is more transactional and may be non-recurring. Brand strength also favorably influences costs by influencing other stakeholders. Therefore, it's imperative to measure the strength of brands and customer franchise, analyze it, and express it in financial terms as a key component of growth. Now, many of us have had these kind of conversations over the years, but we thought what we do today is bring, dare I say, an early adopter of this whole logic train to the fore, and that is our friend and fellow MASB member, David Haigh. David is the CEO and co-founder of Brand Finance. He's worked on branding and intangible assets since 1991. He was director of brand valuation for Interbrand. He's authored many articles in publications such as the Financial Times, Accountancy Age, and Marketing Week. He's lectured on brand valuation at Harvard, Chicago, and London business schools. He is indeed a chartered accountant, although I personally won't hold that against him, but he was with a fine firm at Price Waterhouse in London. And as you can see, his education at Bristol University and the Chartered Institute of Marketing, and he's been on our advisory council since 2013. So please welcome David Haigh, and we'll have a conversation about this topic.
Hello. Hi.
How are you today?
Very good. Welcome to Cornwall.
Thanks. I understand you've had a pretty busy day. You've been dealing with soft stuff, so now we'll deal with hard stuff.
Yeah, I've been having a one-to-one chat with Hillary Clinton.
Yeah, that sounds great. So, as I noted, you've been involved with this topic since 1991 when I was introducing you. What kind of prompted, your first step into it way back when, given the complexity of the circumstance?
Well, actually, my first contact with brand valuation was in 1988, because Interbrand acted to create brand valuations in a big takeover battle here in London. And 3 of my colleagues from Price Waterhouse happened to be working at Interbrand. 2 were in the finance function, and 1 was one of the strategy guys who dropped out of accountancy. And interestingly, Interbrand had been going for about 20 years and had been just a UK-based, London-based naming firm. It suddenly jumped on the idea that brands were assets. And while its finances had been very poor for the previous 20 years, when it got onto this topic, it suddenly became very, very hot. And its first major breakthrough was doing a valuation for RHM, which was a big food firm. And it helped to defeat a major takeover battle. So that was in 1988. And for the next few years, it just gradually moved along. And by 1991, I got involved in the whole thing and started doing brand valuations and being involved with them.
So if we fast forward a little bit, I know that you played a key role in the development of the ISO brand standard, the first brand standard on brand valuation, which for those of you taking notes at home, is ISO 10668. What kind of prompted your decision to be involved with ISO on the brand topic? Because traditionally, marketing subjects are not really seen by many as the realm of ISO, or at least they weren't, until perhaps that time.
Well, I joined Interbrand in about 1994-5, and I worked for them for a couple of years. But I felt that there was a role for brand valuation to be separate from executional consultancy. And so I set up Brand Finance in 1996. For quite a long time after that, we've been working in brand valuation. So the ISO committee to set up 10668 was only established in 2007 and reported in 2010. So there'd been many, many years of very active brand valuation. But one of the things which typified the industry was there were many different proprietary methods, many of which were black boxes, and nobody would disclose how they got to their secret algorithm. And this really irritated me as an accountant. And whenever I talked to finance people, it always really irritated them. So I joined the ISO committee with a view that we would make it all transparent. And I think that's what we've done.
So we're in the midst right now, as you well know, of kind of looking at 10668 and potentially kind of reviewing where we are with that. Because the ISO process, of course, requires standards to be revisited and updated. Knowing that process is early days at this point, do you have anything that you can share with us in terms of things that might be looked at that might enhance that standard, or perhaps make it more readily adoptable by individual organizations?
Well, it's slightly early days because we haven't actually started the deliberations of the committee, and it is meant to be a review of the existing standard.
Right.
I do actually think the existing standard is quite robust, so I don't think it needs wholesale change. But as you know, there are three elements to the ISO. The first one is looking at the legal proof that you actually own a brand and the dimensions of that brand. And I've actually invited the International Trademark Association to participate in our review to see what further work needs to be done to do the inventories and the analysis of the legal elements. The second part is to do with market research. And I think since brand valuation began many years ago, the understanding of drivers of demand and the kind of sophisticated research that can be used has advanced. So that there could be scope for changing that. And of course, we need to look at the financial valuation approaches. There are approaches on the one hand, and there are specific methodologies, and it does actually define a number of methodologies. I think we need to look at those and see whether any need revision and maybe addition. But fundamentally, the structure is fine. And I don't think we want to undermine it because it is increasingly well known. I think more and more boards are realizing that there is a standard. You can value these things, and they're adopting it. So I don't think we want to scare the chickens by throwing it out the window and starting again.
Yeah, I guess I would comment that I agree with that assessment. I think that to many, the black box circumstance which you outlined, the comment that I get quite often is that they think it's still kind of a black box in some ways. So the whole notion of which methodology may be appropriate for a certain type of business or a certain type of brand, I think companies actually need some guidance on that.
I think if you actually look at the ISO, it is very prescriptive at demanding that valuers are totally transparent. The valuations are explicable, the data sources are clear, the method that's been used is clear, that you explain it, that you do a sensitivity analysis, and there is absolutely full disclosure. So I don't think there's any question that the standard does actually lay down quite strict rules about how it should be done. Whether that is entirely always done by practitioners is another matter, but certainly it is done by brand finance.
Okay, fair enough. Given the long-running nature of your involvement with the financial valuation of brands, Are there any case histories, even on an anonymous basis, that you can bring up where by doing the financial valuation of brand, it became a key metric in the overall business planning and marketing planning process to the benefit of the enterprise which did it?
Yeah. Well, I set up brand finance in April 1996. So in about 2 or 3 or a month's time, it's our 25th anniversary. And our strapline has always been bridging the gap between marketing and finance. And it's always been a question of explaining to finance people why marketing is not just some flim-flam thing. It is a real asset, it's a real investment, and you should expect to see a return. And that's always been the case. So throughout the whole 25 years, there have been many instances of where we have used these techniques to try and convince finance people that an investment should be made, or a divestment should be made, or whatever it might be. A business decision is made. I mean, my first valuation, for example, was for a company called British Universal Provident Association, which was a private medical insurance company. And the advertising agency dragged us in to do the valuation because they said that the £5 million that was being spent on advertising was too low, given the nature of the asset. And we did the exercise and we recommended it should be doubled. And I presented it to the finance director of Bupa, and he eventually sucked his teeth and said, yeah, you're right. Good. Okay, I accept that. And then he said, well, given that we're doubling the budget and it's such an important thing, I think we ought to put the agency up for a review. And within about 3 months, the agency was kicked out and a different agency was appointed because they were felt to be more suitable for a £10 million budget. So it's kind of like, the operation was a success, but the patient died as far as the agency was concerned. But the point was, it was a very important decision and the finance director recognized that. And, there have been numerous examples of that with people like Shell and Cemex since then.
So maybe I know now why agencies aren't all that interested in talking about this subject.
The good ones don't mind.
Yeah. Well, on the other hand, if you were able to inject into the conversation a circumstance where they needed to increase their investment in marketing.
I have to say that over the years, 90% of the cases where we're involved involve us saying you're underinvesting. I mean, I think generally companies, apart from a few very big consumer goods companies, most companies do underinvest. So it's relatively easy to end up saying you need to invest more and you need to invest in more smart ways. And you need to look at your segmentation of value to understand where to put the money. So in a way, we're pushing on an open door. We're not normally saying this is a waste of money, cut the budget.
So one of the discussion points that I've had when I've talked to people individually or as part of the follow-up discussions that my friend and colleague Bill Duggan did is that most people don't really see the need to do the financial valuation. They'd like to know what it is. They don't see how it impacts current decisions. And if they do it, they're probably not going to do it on a regular basis. I know you and I are probably of like minds that you need to do it annually because it's not actually the number that matters as much as it is what's the trajectory of the number and how you properly steward that number. Do you have any examples that you might cite of businesses that benefited from doing it on a regular basis?
Well, first of all, historically, it's been one of those things that's been foisted on clients by the consultancies. They're trying to sell a service, and that's what Interbrand did, and that's what we do. My hobby horse has always been that this should be an internal management discipline. It should be built into the fabric of a company, and people should be trained internally to do it, and they should do it on a regular basis. We have a thing called the Brand Finance Institute where we try and train our clients how to do it, and then they bring us in to check things or give them an independent point of view. But it needs to be part of an overall management process. And I think where it is, it's very informative. It helps make all sorts of decisions. We did a project many years ago for Cemex where we created a valuation model. We gave it to them. We showed them how to work it. And for years, they were doing it. And in fact, I thought they dumped the whole idea. And then about 5 years later, they rang us and said, we've been doing that for the last 5 years. Would you mind coming in and giving a service to it? And I was delighted. They've been doing this thing for themselves. And I think that's where we pass the watershed, where, like a lot of accounting disciplines or market research disciplines, they just become regular features of the thing. The second thing is, I think you have to draw a distinction between what we call a branded business valuation, where you're showing the impact of the brand on the business as a whole and the share price and the enterprise value of that business, and the standalone value of the brand as an independent asset as though you've been taken over. Generally speaking, the former, the branded business valuation, is the one that should be done on a very regular basis, and you show the incremental benefit from a brand, and that we would call that brand valuation. Really, it's a branded business valuation. Someone like Unilever having hundreds of individual branded businesses. The other one, the one where you're putting a value on the brand at a point in time, tends to be transactional related. Right. So, I advocate strongly branded business valuations on a regular basis done internally. Individual brand valuations tend to be done for balance sheet, for takeover, for tax, and that kind of thing. And our business is about half and half.
So if you were to point to businesses or maybe categories of businesses that tend to be more engaged in doing the financial value of their brand or brands, is there any one segment of business that stands out, or is it more a function of the engagement of the finance and the marketing people together in the organization?
I mean, I think it's fair to say that fast-moving consumer goods companies have, certainly over in Europe, more readily adopted this kind of approach. So places like Diageo and Unilever have many brand accountants. They call them brand finance accountants. And I've often wondered about challenging their trademark rights, because we actually have the trademark to brand finance. But you occasionally see them popping up as director of brand finance in Unilever. I'm flattered rather than annoyed, but I suppose I should be annoyed. But anyway, they
just ask for a percentage back, right?
I want to protect our trademark, but I don't want to piss off Unilever. So, but they have hundreds of brands, and they're constantly running the slide rule over them in the way that I've suggested. And so, to me, in a way, that justifies what I was saying earlier, that it should be built in as a management discipline. It tends to be fast-moving consumer goods where they have many brands, and they're trying to decide, well, which ones shall we divest, which ones shall we merge, which ones shall we invest more in, and they're all doing it all the time. Then corporate companies, individual companies like Shell or Vodafone, say, they're focusing in on one brand, but they still want to know where can they make the most effective investments to support their brand, to support the business. And so Shell has a big unit in Switzerland called Shell Brands International. There are many companies. Vodafone does a lot of this kind of work. I don't know so much about the States, but I think increasingly it is being adopted in the States.
So to that point, you and I have had the conversation about the various accounting stewards, and I think I certainly have the impression that IASB is kind of more enlightened and more advanced on this topic than we tend to see from the American stewards. Do you concur with that? And do you think it would be in the interest of advancing this topic, something that we should be engaging with IASB or some other international body to move it forward on the accounting side?
Yes, well, I think one of the interesting points, as an accountant, this is me talking as an accountant, over here, certainly in the UK, they talk about principles-based accounting. And then they talk sneeringly about America and say, well, it's rules-based accounting. So in other words, if you look at the Federal Accounting Standard Board's standards, they run to hundreds of pages, and they say precisely how you will do everything. Over here, they have a very short standard, and they just say, look, here's the principle, do it this way, which gives a lot of leeway to accountants. And this is why, back in 1988, the accountants who were responsible for the takeover battle that Interbrand got involved with felt it was okay to put a value on the brands and stick them in the balance sheet. It caused a huge argument with the more conservative elements of the accounting profession. But they said, well, these are assets. On a principle-based approach, we should be allowed to put it into the balance sheet. In America, there was a prescriptive rule saying, no, you can't do it. And so it's interesting. America is stricter in many ways on the accounting side than they are over here. There's a more liberal attitude. And if you look at IASB, they have been trying to drive forward standards. They want better reporting so people can understand financial statements better. So absolutely 100%, you should engage with them. And in fact, right at the moment, the IASB is running through a review of what's called the International Financial Reporting Standard 3, which was brought in 2004. And it's the international standards saying that when you make an acquisition, not just you must set up intangible assets in your balance sheet. But all they say as well is that while you put them in at a fair value at the point of acquisition, you're not subsequently allowed to revalue them. Now, I don't like that view. I think once they're in the balance sheet, you should be allowed to revalue them. I also believe that if you have homegrown ones, you should be allowed to value them. And this is, you run into the problem here that they are not 100% convinced the valuation methods are strong enough. But as soon as they are, I think they probably will relent. And you guys should be lobbying.
Yeah, so we're definitely trying to do that. I think for many in our audience, they're aware of the Morribund Effect, which is the circumstance where you could buy a business. I tend to use, although my friends at Coke may not like it, I tend to use vitamin water as an example. So if you're the owner of Coca-Cola stock, you can see the value of vitamin water because it's been a purchase, an acquisition by Coke, and with other brands too, but you can't see the value of Coca-Cola, which is more material, shall we say, to the value of the company, because that's the brand that's a lot of the volume. Related to that is when Coke buys a brand of beverage, that brand has got access to the Coke distribution system. So you're going to see volume go way up, yet the accounting convention is such that even if the business was going to grow substantially, and therefore the brand was probably more powerful, if you did a legitimate valuation of it, you're not allowed to increase. You can only decrease the value once it's put on the balance sheet. So those circumstances are clearly contrary to what all efforts in marketing kind of go to do. So,
there are a lot of very weird anomalies. Like if you take Diageo, they've got Smirnoff in the balance sheet, but most of their other brands aren't. Right. You take Cadbury's, they didn't have Cadbury's in the balance sheet until they got taken over by Mondelez, and now they're in the balance sheet. It's just so ridiculous. Our view, and we've been lobbying for 25 years, is that all brands and also other intangible properties should be valued on a regular basis. This is where it comes back to some extent to Sarbanes-Oxley. Sarbanes-Oxley says that accounts have to be accurate, and the CEO and CFO have to sign off to the fact they're accurate. And so therefore they worry a lot that if they allow homegrown brands to be put into balance sheets, that the valuations won't be accurate, and therefore they'll get rocks thrown at them. So a lot of this comes back to how reliable and accurate and how much confidence can be put behind valuation methods, which brings us back to ISO 10668. If you believe that it is a robust standard like other types of valuation, and that the practitioners are robust, then there is no reason why these valuations shouldn't go into the balance sheet, just like a property valuation. And our strong belief is the standards now are strong enough, and the valuation standards and professionalism are good enough, and it should happen. It's overdue.
So a frequent conversation, which we're going to address actually in that financial value of brands imperative that you have with accountants about brand value, is building on what you said. They would say the brand value number, the financial value of brands number, is a soft number, right? So I am not an accountant, although I have many that I know, including my brothers. The fact of the matter is, when you start talking to accountants about their numbers, I typically poke at the inventory number, right? Because the inventory number is a sample number. I said, there's a methodology that everybody agrees to, and that's how you come up with that number. But that doesn't mean on the last day of the fiscal year that precise number that you're putting in there is actually 100% accurate, but it's actually pretty well stated, and people are accepting of that. We're getting to the point, I think, that there's more precision around the financial value of brand numbers, that this conversation is worth having again.
I think I'm not going to be mean about accountants, because I am one, and I think they're wonderful people. But the fact of the matter is, if you look at a set of accounts, just about every single number depends on an opinion.
Right.
No number is absolutely 100% accurate.
Right.
And the same thing is true of all the assets, whether they're pension liabilities, pension assets, stock anything. And, I think their attitude is long, long overdue. The most important single asset class in companies, in most companies, is the brands. And it is ridiculous where you're supposed to be presenting a set of accounts that give a true and fair view, where there are valuation methodologies, and most people accept that there are. And even most accountants you talk to day day go, oh yeah, we know brands are valuable, but you're not allowed to put them in the balance sheet. The whole thing is ridiculous, and it's long overdue for reform.
Well, so I may be increasingly in the minority within MASB, but from my perspective, the first thing to do is get people to value their brands. If you bring up the balance sheet right away, you're going to get even more resistance than we have right now on that issue. So Frank, you sent me a note that there are some good questions there. Do you want to maybe see if we want to answer a couple of them, and then Dave and I can continue based on the responses?
Sure, great. One of the first ones we have is from Rob Swadish, and he asked a two-part question. The first is, to what extent do B2B versus B2C valuations differ in process and results? And then he asked, for the B2B companies, are you able to factor in the value of the brands for which they work?
Okay. In principle, any company with a brand, if it's a good brand, will see economic benefits to the business. Question is measuring them accurately in order to put a value on them. So a good brand will affect all the stakeholders, the staff and their behavior. Do you get them for longer? Are they cheaper? The cost of capital, but above all, the customers. And so when we do valuations, lots of valuations for B2B companies and B2C companies. The difference is that where you're doing B2C companies, you can do large scale market research and you get a greater level of confidence about the uplift effect that's directly attributable to a brand. But there are lots of different research techniques to identify what the uplift is from a B2B brand. And certainly for 25 years, we have not been concentrating just on consumer brands. We've been doing both kinds of brands to help make decisions. And I think, have a look at one of our brand valuations. They're usually quite convincing that you can demonstrate. For example, just take a brand like McKinsey. I remember we did a valuation for McKinsey informally about 20 years ago. And the partner said to me, we know our staff are pretty much exactly the same as all the other serious strategy consulting firms, but we charge a 25% premium. Go out and research amongst CEOs and ask them what they pay. And I remember we once did a pitch where this was actually for Telefonica, and we were put through their procurement process. And I remember talking to the jerk who was in charge of procurement, and he said, oh yes, we put you in this band here of consultancies. I said, well, why did you put me there then? And what are the other brands? Or what are the other bands? And eventually he said, oh, well, there's this band, this band, this band, and there's this one at the top here. And I said, well, who's in that one? He said, well, there's only one company in there. It's McKinsey, because that's the one that the chairman wants. And he said, oh yeah, he rolled his eyes and said, yeah, the prices are about 30% for them. And I thought, well, that's ridiculous. But the fact is, the McKinsey brand is a very powerful B2B brand, and there are many like it, and people will pay a significant premium, even for like service. So yes, it definitely.
My guess is your McKinsey brand valuation would be slightly different today, given the changing executive suite there and the recent discussion on opioids. Their brand is probably a little less sturdy than it once was.
Yeah, I don't think it's very strong in South Africa, for example.
Well, or in certain parts of the United States. Frank, do you want to go to a second question?
Yeah, we actually have a hand raised as well from Jim Meyer.
Jim, go ahead.
Tony and David, can you hear me?
Yes.
Yep. Okay, excellent. Question for David. Just wondering if you could speak to the dynamics that you've run into from your experience on, the degree to which you've encountered executive buy-in, or what I might call executive opt-out, in terms of what you're attempting to do, and how that plays a role in the effectiveness of what you can provide to enterprises.
Yeah. Do you want me to answer that, Tony?
Sure, I can jump in if you need at the end too. Okay.
Well, I've noticed a very definite, gradual but relentless change over the last 25 years of brand finance. When we first started, you nearly always got laughed out the door. They thought it was mumbo jumbo and sort of magic. Nowadays, most companies take the conversation seriously, certainly in most parts of the world. And I think actually we do quite a lot of business in the States, and I think they're increasingly taking it seriously in the States too. But it depends on the organization. Some organizations are dominated by very conservative, old-fashioned accountants, and they whisper in the ear of the CEO saying, this is all a load of garbage, just ignore it. If you have a slightly more enlightened finance director and you have a slightly enlightened CEO, and the CMO is good at talking business, you definitely get accepted and you're in and you're doing important work. But there are still quite a lot of old-fashioned companies that just don't get it.
Yeah, and I would build on that. So I think there's a fair amount of momentum on this in the States. When we've reached out to do briefings on the whole notion of financial value of brands, we've gotten very good response in terms of some of the largest companies here in the U.S. that have substantial brands that everybody would recognize. I don't think that would have been the case even 3 or 4 years ago here, but it's got a lot more momentum than it did. And I think that's, because a lot of the work that the team at MASB is doing, and it's also because this whole issue is getting more attention from a kind of macro accounting standpoint, with intangibles growing on balance sheets. The whole notion that you're going to have this number that's not defined, that is essential to the success of your enterprise.
I mean, just
one.
one specific client anecdote, and this is all in the public domain because our clients have allowed us to talk about it in the past. One of our very first clients was Shell. And I remember one of the very first projects we did for them was to put a value on their brand. And I've forgotten the exact number, but it was something like $15 billion at a time when the company we were worth $200 billion. And our client took this to the board and they were all going, what? No, don't be ridiculous. It can't be worth 15 billion. And the obvious conclusion is if they accept that it's worth 15 billion, they have to invest in it and support it and defend it in the same way as they would on any other $15 billion asset. And after a bit of argy-bargy, they did actually come round to it. And what it then did was to change the whole dimension of what they should be investing in their marketing, and in particular, what they should be investing in their sponsorships like F1. And within about 5 years, we had convinced them that they should separate out the brand from being just a little logo department in London and make a brand co. We effectively lobbied Shell to set up their brand co in Switzerland. And we did a lot of the preparatory work for it to go there. And we've worked for Shell ever since. And they now have a very successful brand co in Switzerland, running it as an asset throughout the network. Perfect case study of how a thing has gone from just being a sort of Cinderella logo department with a few logo policemen to being really quite a central business asset.
And as a matter of fact, I was on an ANA CMO call this morning, and the gentleman from Shell was speaking about how they're now licensing Shell to other places in business that you never would have traditionally thought them to be in, again because of the strength of their brand. So it's a very positive example on a number of different levels.
And we have a question which might go very well with that Shell example. The question is, how can we really evaluate the brand value solely from brand's perspective? For example, how can we really identify the financial value of the Apple brand name and brand only if we separate it from the overall performance of Apple? So basically, brand versus total enterprise value for for an enterprise where the brand is the name of the company as well.
Well, I'll start, and David, you can feel free to jump in.
Mm-hmm.
The brand effect goes beyond the customer franchise, right? We've had pretty robust discussions, and David's been a key contributor to that, about how a powerful brand can get better terms in the supply chain because the people in the supply chain kind of trust the business is going to be there today, tomorrow, and in the future. You might even get better terms from lenders or financing because that familiarity drives it. So there's a lot, the brand effect goes beyond the customer franchise. I think we're aware of that. I think David, maybe I'll let you speak to how methodologies can make sure that they note that there is that kind of value beyond the transactional nature of the brand.
Yeah, I mean, as I said at the beginning, you have to look at each stakeholder group and you have to identify how they are affected, how their perceptions are affected by the brand, and how that then affects their behavior, and then estimate what difference you think that will make to the economic performance of the business. What you're always looking at is the incremental uplift to the value of the enterprise as a result of having this strong brand. Now, the biggest effect is nearly always the uplift effect you get from customers, the extra volume, the extra price, and the extra longevity of demand. And you can nearly always measure that. I remember once we did a valuation of the RAC insurance brand, the Royal Automobile Club, la-di-da. And it was incredible that the lapse rate on their insurance, their car insurance, was like 2%. And yet their premiums were 5% higher than anyone else, because the customers were so loyal to them, because they liked all that sort of branded la-di-da royal stuff. And that's basically the brand. If they had gone to another car insurer, they would have got the same deal, much cheaper, but they were a very sticky brand. And so you could measure, what was the difference as a result of having this thing, and then put a specific value on that brand. And so at a granular level, you have to look and see what difference does having this brand make to people's choice. And then you can scale that up into the financial model and put an aggregate value on that. And that's how you get your brand contribution and your brand value.
And I have a related question here from Mike Donahue. I'm actually, Mike, I'm going to unmute if you want to just ask it directly.
Yeah, the question I have, can you hear me?
Yes.
Yeah.
Okay. Does in Mr. Haigh and also Tony and the whole MASB group, does brand valuation ever take into account, especially because you're all about profitable growth, the value of profitable users? Those 10% in a franchise who account for 50% of the profitable volume, because as Tony and I know, smart marketers don't price promote against their profitable users because they don't have to. They're price insensitive, and they can take that money and invest in other ways to drive the enterprise. Whereas the brand occasionalists only come in when the price is cheap. So my question is there any focus on these profitable users, because they are the ones driving profitable growth?
Do you want me to I could answer that in relation to that case study I just told you about a moment ago, the RAC.
Absolutely.
Because this is a case study I worked on about 25 years ago, and they've been taken over several times since. But basically, at the time, something like half their business by volume was going to car companies like Mercedes, who would buy it in bulk and give it to the people who bought their cars. And so you vaguely knew it was coming from RAC if you were a Mercedes buyer. But the Mercedes procurement people drove the pricing, the procurement down so low that they were making almost no money. And the people at the RAC were desperately happy to have all these Mercedes drivers driving around with RAC insurance, but they were almost loss making. Whereas the segments that were older, richer, driving older cars, they made lots of money out of them. And so what that demonstrates is that when you do a brand valuation, if you want to get insight from it, you need to do a segmentation by geography, by product line, and by customer type, and then look at the value of the customers and work out where are you maximizing your value. This is where brand valuation is actually a very dynamic management tool. It is not just a point in time where you stick it in the balance sheet. It's a way of identifying how you are making money and how you could make more.
Well, and one final thing, if I may, there are three different consultants, Forrester, Bain, and Gartner, who 2 months ago in the same week said that, and these were the CEOs and CFOs, said that any marketer, any CMO who thinks that their money is coming back to the way it was before COVID are being at best optimistic, at worst naive, because we are going to require them to be more effective and efficient with less spend. And that plays right into focusing on profitable users, and companies need to do that more. And if they did, brand valuation would go up and MASB would be much more valued than it is.
Thank you,
Yeah,
Mike.
that kind of presupposes that what people are spending their money on at the moment is inefficient. I mean, if you've got a marketing department that's good and has been spending money effectively,
Well, I would say that
it would be
there's
illogical for management to expect you to get more for less. Really, they should accept the fact you've been doing a good job and give you more anyway. Every case is different. You need to look at the circumstances.
But
well, the great debate there is you can make a lot of money selling to your current customers, but in the long run, if you're not adding to your customer franchise, you're not going to be a profitable business, and that dynamic's there in many businesses.
Yes.
Frank, I saw that Don Sexton had his hand raised.
Yes. Don, do you want to ask your question?
Okay, can you hear me?
Yes.
Yeah, David, good to see you. I think the last
Hello.
time we saw each other, we sat next to each other at a brand conference in Shanghai. So
Yeah, I think we did.
glad you made it back. I have a question. It's kind of a general one, and I don't mean it as a trick question. It may sound that way. When you approach any forecast, one way of sales or anything, one way to forecast is to try different approaches, 5 or 6 approaches and average the sales forecast. Now, one could say maybe in brand evaluation, a good way to go would be to hire 5 or 6 brand consultancies and average their results. Now, I know there's a short answer to this question. Why don't you just hire brand finance? And I accept that. But I wonder if there's any merit
Well,
to.
I don't mind if a client hires 5 as long as we're one of them. Well, you don't necessarily have to have 5 consultancies, but it isn't necessarily a bad idea to have 5 scenarios and then evaluate which one is more likely to happen. Like where you get into a complex brand valuation, you might have 5 different scenarios and probability weight them. But normally what happens is that you end up with one forecast, but implicitly it is it's having gone through the various options to arrive at what is the most likely outcome. But there are people who will do a high, low, medium and take probability on them, and I think there's a lot of sense in that.
Thank you.
Thanks, Don. Frank, I think we have time maybe for one more question.
All right. Let's see. Which one should we do? We have several here. I'm going through to see if there's one that we haven't got correct. How about Gerhard? So Gerhard asks, how could brands contribute, especially in post-COVID crisis, to the financing of companies? How can they be used as collateral for loans when they are that valuable? How do you see the developments and challenges there?
I think the primary thing is, if you go back to Warren Buffett, he always says he invests in companies where he knows, likes, and respects the management, but also where they have got moats to help protect themselves. And he knows that the moats are all intellectual property based, brands, patents, and other types of intellectual property. So when you go to an investor and they're looking at your health post-COVID, they are going to be looking at these things. Do they like the management? And do they believe that it's got unique IP that will help protect it in the post-COVID period in order to recover? And then they will make their decisions about whether to invest or lend money to it on the basis of all of that. So it's very important to be able to demonstrate that you do have a strong brand that will recover and rebound. Here in the UK, when I look at companies that are up the creek, very often they're the ones with the weak brands. And you can look at the ones with the good brands that have been out of commission for like 6-9 months. They're going to rebound as soon as everyone's, able to go around and, go shopping and buy stuff and do this, that, and the other. So it is very important to have that due diligence to give it to financial investors.
Great. Well, David, greatly appreciate you spending.
Can I just say one last thing, actually?
Sure,
I think my perception, I've spent years and years and years trying to get into America with our service. And for many, many years, it was rejected out of hand. I love the fact that it is now being warmly accepted. I think one of the big challenges has been that finance directors have characterized the whole brand valuation debate just as putting one number on the brand, sticking it in the balance sheet. And they go, well, I'm not really that interested in that. The really useful thing and interesting thing and exciting thing about brand valuation is where it's a dynamic technique for making decisions. But I tried for years to explain that to finance directors. They would never get it. But I think fortunately now that the marketing, MASB and others have taken it up, hopefully we'll get that message across. It is a management technique. It is not just a valuation at a point in time.
Yeah, I think to us, kind of reiterating what you said, it's got to be part of the key management decision-making process, right? And
Totally agree.
I had a number of calls from folks early in the pandemic whose budgets were eviscerated, saying, "Can you help me with this?" And I said, "Do you have a?" I basically used the brand valuation piece. I said, "Do you have any legitimate estimates of the value of your brand?" And we went back and forth, and some of them did, or some of them did a kind of a rough version. I said, tell your financial friends you've got an asset that is worth this much. Shouldn't you be protecting that during this circumstance in some way, shape, or form? And that at least started the conversation. The other piece, which I know my friend Dave Reebstein has heard me say a couple times, is to all of us in MASB, we know the importance of brand preference, right? When everybody was pulling back, to me as a marketer, the notion was brand preference was on sale, right? Because it was a lot easier to get visibility during a time when there's nobody else out there. It's, the old baseball axiom from Wee Willie Keeler, hit them where they ain't, right? If nobody's there, you can stand out and you can talk to people. And in so doing, strengthen your brand. And if you can do it for less money, why the heck wouldn't you do that? I think that became, at least with a few people that I had conversations with, that became something that they were willing to try and may have positively influenced the conversation. Frank, I think we got one last hand raised from Joanna Seddon.
Hello?
Sorry, Joanna, you should be able to speak now.
Yes, great. Well, I wanted to heartily second what David said just now, which has been, I've been trying to ask a question about for some time, which is that brand valuation, I think, in my view, has value primarily and overwhelmingly as a decision tool for management to figure out how to manage brand marketing and the whole customer experience and everything they do in a way that will enable brand to work better, to add more value to the business. I also, and this is something where David may not agree with me, feel that there is often a conflict between two uses of brand valuation, which relates back to what Tony was saying about just putting a number on the balance sheet. If you just put a number, if brand on the balance sheet tends, I think, to be a distraction. It forces it back into accounting land. It forces it back into one number. Balance sheet, they're done for a particular purpose at a particular point in time. They're not useful. And I think our experience, which is in the US, is when we don't call it brand valuation, which gets it away from the whole balance sheet, but say, do you want your brand strategy and your marketing investment and your business decisions linked to financials or not? They will say yes, and then you use brand valuation. And then at a certain point, you can tell them it's valuation. But I think that putting brands on the balance sheet may be more of a problem than a help to to the future of brand valuation. So it'd be great to have your perspective on that.
Yeah, so I fully agree with that, and that's why I'm the nudge that is fighting it within MASB, because I think going there is going to preclude progress on the issue.
Perhaps inevitably I would have to disagree with you.
I thought you might as an accountant.
But I think we're sort of dancing around the same thing, because like I said earlier on, there are two quite different things here. One is the valuation of the branded business as we define it, which is a sort of a subset of a larger enterprise. And if you look at someone like Unilever, they have many, many branded businesses, and you evaluate them separately. And you're looking at how the specific intangibles drive the value of that branded business. That is for decision making. We make that clear that it is a branded business valuation for decision making, and everyone should be doing them. But periodically, you need to put a valuation on the specific asset, just not least for tax. One of our biggest clients for the whole 25 years of brand finance has been tax authorities and clients who are arguing with tax authorities. Because if you move a brand from one country to another, they will try and charge you tax on it. So you can't avoid the fact. And Shell, when they set up Shell Brands International in Switzerland, they paid a huge amount of capital gains tax to move the brands to Switzerland. And we've worked with many, many, many brands doing the same thing. So you can't just say, forget it, it's a distraction. It is not a distraction. It's very much center stage for finance directors, but they are different things. And you just need to be able to explain the two to finance directors.
So thank you, Joanna. David, thank you so much for joining us today and
Okay.
sharing your insight and wisdom on a topic that's important to us. I want to say to the entire group, so both David and Joanna and Jim Meyer, and I'm probably forgetting everybody else, have been contributing greatly to the development of the paper on the financial value of brands imperative. Frank, at the end of the session today, there will be a box where you can fill in that you're interested in receiving that as kind of an advance copy for comments. Again, we take everybody's comments seriously on that, but as you might imagine, we also have to navigate getting a succinct, coherent, persuasive document together. So we look forward to your feedback. We hope to be in a position to publish this in the very near future. So
thanks for inviting me. It's been fun. Thank you very much.
Thanks, David. Great having you.
Bye.